Good afternoon, everyone. Thank you very much for joining us for the next 45 or so minutes. My name is Neil Chopra. I'm going to be moderating this panel with three of our very esteemed peers in the industry. Really excited about this. Just for some backdrop and context, all of these institutional players are doing and have been doing a lot of work setting the stage and the building blocks to enable institutional adoption, not only of crypto, but blockchain as a broader technology. So really looking forward to this conversation, hearing really where we've come from over the past 5, 10, 15 years, and what are the next steps to really enable and foster the adoption and the utility of this emerging technology. So with that, I'll maybe hand it over to Dan and do a quick round of intros so everybody knows who we're talking with here, and then we'll dive into it.
Thanks, Neil. I'm Dan Doney, the CTO, Chief Technology Officer at DTCC Digital Assets.
Yeah. And
Alex?
Yeah. Hi, I'm Alex Prager. I'm the head of Kinexys Labs at Kinexys by JPMorgan, our blockchain business.
Hi, I'm Sergey Nazarov, the co-founder of Chainlink.
And so really right off the bat, there was an exciting announcement this morning with JPMorgan, Ondo, and Chainlink. So Alex, Sergey, would love to just allow you guys to maybe spend a couple minutes to talk through what that was and what you're looking to enable with that.
Yeah. Want to go for it?
Yeah, sure. So the Kinexys payments solution from JPMorgan, which has its own kind of payments chain for cash settlement, is now able to be used to do the cash leg, the payments leg of a delivery versus payments transaction for delivery of an asset on the Ondo chain. And that asset is like a tokenized treasuries product. And the interesting thing about this is that cash settlement chain on the JPMorgan side, which has been working well within the JPMorgan infrastructure for many years now, is now for the first time being connected to external public chain systems. So it's part of this larger trend of where institutional chains and institutional systems are being connected to public chain systems where they're finding more and more high quality assets, in this case, a tokenized treasury from Ondo. And so it's kind of showing that trend is very real, and that trend is beneficial to both the institutional participant, because the institutional users of JPMorgan's cash settlement system have now access to these tokenized treasury funds. And it's obviously beneficial to the tokenized treasury fund issuer in their ecosystem, because they have this big JPMorgan ecosystem of cash purchasers and liquidity that can access that.
Yeah. I think it's really, really exciting. You know, for years, we've been looking at different ways of interoperability. How do we think about the broader ecosystem and not, what may happen on one chain over here or, network over here. And so, seeing the progress there and the ability to look at different ways of interoperability have been really exciting. And I think today's announcement, showcases all the work that's going on and will go on in the space.
Yeah, and I mean, to that end, looking at sort of where we've come again over the past several years, I think it's really interesting to see a lot of the larger players stepping in to really enable what I'll call this more crypto or digitally native offering. Because if we have any degens out in the crowd, they've probably been saying, hey, I've been accessing DeFi and doing DVP and interacting with smart contracts for years now. And I think that we've seen a lot of the proof points over the years of retail sort of showing us the way, right? Showing that this model works, it's efficient, it's scalable, and it's secure. And so would love to hear, even just from your personal experiences, how you kind of got into this space and how you sort of translate your, I'll say, real world knowledge and experience working with blockchain and crypto to how you're kind of managing different projects, initiatives at your institutions today. Maybe Dan, I'll let you dive in.
Well, it's actually interesting to see how this conference has evolved over the years. First of all, the clothing is a little bit different. 10 years ago, it was a pretty wild attire from the conference.
No capes this year that I've seen it.
I haven't seen any either. I'm kind of disappointed. I was hoping for a couple. But that also reflects the kinds of investment opportunities and the crowd in general. It used to be that 5 to 10 years ago, it was what kind of wild investment opportunity was it? You could invest in race cars, you could invest in sports teams, you could invest in your own island if you wanted to. These were interesting for sure, but not projects backed with a real investment thesis. And that's fundamentally different today. So, just this example with real world assets, this is now a very real disruptive force to traditional finance. And for example, in our case, our focus right now is bringing $100 trillion worth of assets the DTCC is responsible for on-chain. Many folks here may not know who DTCC is and what we're responsible for. We're the principal record keeper for the U.S. financial markets. So we are all publicly traded securities. We hold a principal record keeping role. We're responsible for T+1 settlement. We're owned by the major banks and institutions. So effectively, we're a DAO for the U.S. financial markets. We're determined T+1 settlement is not good enough. We're really looking to take advantage of real-time settlement from blockchain rails. And it's our responsibility to bring those assets into the market. But we wouldn't agree that the world has demonstrated that blockchain rails are secure and efficient, because they aren't. There have been, there are examples of theft of $1 billion or more. Imagine that's $100 trillion on chain and multiple trillion dollars that got stolen. That can end or wreck an economy. So there's a lot more work that needs to be done. We're working hard on those tools to make sure that blockchain can really work for mom and pop all the way up to institutional settings. That's our focus for now.
Oh, and
Yeah.
Alex, I think your perspective from the JPMorgan side would
Yeah, definitely. So some folks may not know, but we've been doing blockchain for the last decade at JPMorgan. So back in 2015, really took a hard look at the promise of the technology and how we could apply it into financial services. So we've been at this for a little bit of time, and we did a lot of different testing and experimentation in those first 5 years to figure out, getting hands-on with actually tokenizing an asset. What does that mean? Okay, great. Now we've tokenized the asset, but now we don't have cash on chain. So that's not super useful to us. And then developed, fiat on chain capabilities. And okay, that's fantastic. And now there's more things that we can do. So we've looked at different things over time. And in 2020 went live with our product. So we've got 3 different live networks. And now fast forward to today, we've processed almost 3 trillion in volume, 2 trillion in volume. And so it's really exciting to see how that moves over time. And along the way, what I really love about doing this at JPMorgan is that while we're proving real value with real world assets and fiat on chain, we're also experimenting on the side and watching the ecosystem, because that's where the developments are happening. It's this room. And so, in 2022, we were the first bank to do an institutional DeFi trade. And we used our digital identity product to, show how you could actually authorize users to interact in a DeFi pool. In 2023, we did a lot of work with interoperability and used different interoperability solutions and different institutions to actually process trades on different chains. And then, last year I looked a lot at privacy and identity. So alongside our, live networks and products, we're also, we always have one eye to what the rest of the ecosystem is doing, because that's where, a lot of the new development and the learnings are, and then figure out what is the best way for both crypto natives and traditional finance to work together.
Got it. And I guess, Sergey, maybe a little bit of a tangential question, but Chainlink sort of I won't say spawning, but evolving out of more of the retail space, which is what crypto was 5-6 years ago, with a very intentional focus in institutional. How do you sort of look at that and sort of balance the two narratives that are kind of out there in the market running in parallel, which is very much crypto retail and then institutional adoption working within regulated market structure?
Yeah, so when you're building a startup or a community, and you're building what we're building from the point of view of a technical standard for how all these transactions and systems can work together, as we just discussed as in our example, you kind of have to execute on the things that provide value to the market and to the community today, and you have to figure out and architect and plan things in a way that you can provide, or the standard or the system can provide value in the medium and the long term. So my work with the capital markets community really began maybe about 10 years ago when we were only a few people. We're in the single-digit number of people working with me on blockchain things. And we won an industry challenge from Swift. So there was some kind of industry challenge, and the industry challenge involved a lot around a technology called oracles, which we were like on the cutting edge of and the leader in. And so we just like less than 10 people in total went into this industry challenge in London, and we won that. And then over the last 10 years, as I've worked with both the capital markets and the DeFi community, what I've really subdivided the world is into two separate buckets. One world is what I call non-compliant capital. So pseudonymous, anonymous capital, which powers DeFi, Bitcoin purchases, cryptocurrencies, that world. That world for me, when it crossed 500 billion, I think reached kind of an escape velocity.
Yeah.
And you're right in that a lot of our technology and work came out of that world over the last 8 years at Chainlink because it was the place that was doing things on production, right? And you have to provide value on production in order to exist if you're not a big organization that provides value in other ways, right? At the same time, as we've been working with the DeFi community in parallel, we've been working with the TradFi capital markets community. This example with JPMorgan is one good example. Another good example is our work with DTCC before on something called SmartNav, where we put data about NAV calculation on chain for tokenized funds and this stuff, and many other examples. The other category is the compliant capital category that the DTCC and JPMorgan are really the top two players, I would say. Like if I had a choice of the top two players in the US economy and maybe in the global economy in relation to the amount of capital and amount of things, it would be JPMorgan and DTCC. JPMorgan's the leading US institution, and the DTCC is the leading financial market infrastructure of the world, right? Yep. And we've had some amount of work with both of them that's now public. What I've found is that the non-compliant capital, and this is why I bifurcated this way, the non-compliant capital doesn't care about compliance. So they can just do things. They can build decentralized exchanges. They can build lending markets. They can build tokenized whatever. Even stablecoins, for me, kind of fall into non-compliant capital for their first iterations because they weren't doing it in like a super compliant way. They were like in a gray area, right? Now they're becoming compliant. Compliant capital is much, much larger. So non-compliant capital takes our industry from that 500 billion to 5 or 6 or 7 or maybe 10 trillion, in my opinion, depending on how much people want to allocate to cryptocurrencies. The compliant capital takes our industry to 100 trillion plus. And so my view is that our standard needs to power the non-compliant capital use cases and the compliant ones and eventually merge them into what we call the Internet of Contracts. And in that Internet of Contracts, you will have institutions like JPMorgan, in my opinion, playing a leading role. You'll have technology providers like Fireblocks as a leading provider of a lot of the signature and custody technology and this technology that various institutions and counterparties in the compliant capital world use. You'll have technical standards like Chainlink that define how some of these transactions work. And then in my opinion, what's actually going to have to bring it all together are FMIs like the DTCC. So the DTCC for me is an absolutely critical participant for the US economy and the US regulatory environment and the Web3 environment to transact in a way that brings compliant capital in. Because the DTCC will help define what compliance is.
Yeah.
And in helping define what compliance is, they can unlock all of this capital to flow into our industry through the standards and the things that Dan and his team have built at Securrency and now at the DTCC. But I think this panel is actually I just wanted to say this at the start. I didn't have a chance, but I know I'm talking a lot, but just to say one thing. I think this panel really shows the kind of future of our industry, right? Well, where you'll have technology providers that can accelerate things. You'll have large institutions like JPMorgan that want to genuinely provide high quality financial products into our industry. And you'll have FMIs like the DTCC that'll help kind of smooth how all transactions happen, the way they smooth out how all transactions happen today.
Yeah.
And that's kind of the exciting future that I see.
Yeah, and just to piggyback off of that as well, I'll say from a Fireblocks perspective, certainly what we are building towards is this concept of convergence. We grew out of the institutional crypto trading world. We now see and know that traditional institutions are stepping in. It's not going to go to either end of the spectrum. They're going to meet somewhere in the middle. And I think that's where we're really starting to see some of the adoption and utility of these compliant capital assets coming into the system, which is tokenized money market funds as an example, and their use as collateral for derivatives trading as an example. So to that end, Dan, it would be great for you to maybe give some context on the collateral demo that you guys have built out in that solution, because I think that really does show this future state of global collateral mobility and all of the benefits that it can provide to every market participant that's involved in these transactions.
Yeah, look, I want to finish on the previous point because I think it's important, then pick up because it dovetails in. We'll be there as an ecosystem when there is no distinction between institutional and retail. They're all part of the same fabric. So currently there's a set of services that are only available at the institutional level and that aren't available at the retail level. Well, that's not right, fundamentally. It's not because of bad people. It's because those processes are so inefficient that they don't scale out so that retail investors can take advantage. We're seeing that change as these services become much more efficient. Now, the part that was missing in the past to cause the tipping point for the institutional level, it was two different worlds. So if I wanted to work in the blockchain space, I had to build yet another accounting system on top of the 13 accounting systems that I've already got. There's very little additional value to my customers. If they're doing trading, they can already trade on my existing systems. So there wasn't a cost benefit until a few weeks ago. So a few weeks ago, we demonstrated collateral operations at global scale. Now, the reason why this is so important, it turns out most financial transactions at the institutional level are driven by collateral. So if you look at daily trading activity, trading of shares of stocks is small by comparison to the volume of repo trades and of margin trades, etc. It's much bigger in terms of transaction volume, and it requires advanced collateral processes in order for this to take place. Well, legacy systems don't move collateral fast enough. And on April 9th, DTCC was responsible for approximately $20 trillion worth of transactions on that single day. That was largely due to market volatility. Locked up collateral, it typically takes about a day to be able to move the collateral in existing systems, will cost banks on that day $100 million. Well, it becomes very easy to justify an investment in a technology that can help you settle collateral instantaneously. And that's in fact what we showed. Blockchain is better for real-time transactions at global scale when there are advanced rules that need to be enforced in smart contracts. But this is much more sophisticated than your day-to-day DeFi protocols. So there was a lot of work that had to be done to get to this point. But we're really at that tipping point where I'll tell you, every bank that we work with at all the major institutions are not just dabbling right now. They're racing headlong into this space because of the financial difference. The impact on the bottom line is finally there.
And you know me, I'm all in on this, waiting for it to happen. My colleagues and I have been spending years trying to drive it. I guess the question that I have, if we look at it through a realistic lens over the next 3 to 5 years, what would you say each of you are kind of the one biggest hurdle, and we'll say excluding regulations because we know that is going to be a bottleneck, but outside of that and the things that we can control, what would you say are sort of the priority pieces that need to get figured out so that we can really start to enable and foster the adoption?
Yeah, I think from my side, it's a couple of things that have been persistent for a little bit of time, but now that there are more and more players getting involved, I think it comes to the forefront a bit more. If I think about the way that institutions interact today and the systems that they use and what they've gotten used to, I think we're past the point of, okay, I'm fine with using a blockchain system over here for this one asset because I'm going to be able to prove something out. I think we've proved the value already. And now what institutions want and their clients is to have their entire portfolio in one place that they can interact with as opposed to different systems. So I think being able to deliver the same experience that clients are used to today is very important. And so we're seeing a lot between the bridging of Web 2 and Web 3 client experiences. And I think continuing to build those out will help with the next piece, which is scale. And I think now, we've seen in, I guess, the last 5 to 10 years, a lot of activity happening on permission chains. Our networks run on permission chains today, but the ecosystem is huge. And so I don't even think it matters if you're on a permission chain or a public chain. It's how do you interact with each other? How do you deal with fragmented liquidity? How do you deal with interoperability, privacy? How do you make identity scalable and private on-chain? Like all of these pieces together, I think create that glue that actually lets it all run. And the other piece and last one I'll mention is how fast do they work today, right? Like there's some amazing technologies out there and being developed. But to Dan's point, there's trillions being moved in the traditional markets today, and speed of those transactions is paramount.
Got it. And I know, because we've had conversations about like digital identity as an example and like wallet verification and credentialing. How do you see sort of the institutional side coming together to really figure out what those standards are? Because today you have 15 banks. They're probably asking for about 80 to 90% of the same documentation, but ultimately still need proof of having all of that, reviewed all that, signed it all off. How do we get to this sort of scale or standardization of something as simple as just KYC or credentialing? Any of you guys?
Really quickly on this one, we've been working on digital identity for almost the last 5 years. And so we really believe that decentralized identity solutions are the answer, and to think about how you can actually reuse credentials in other places so that you aren't doing, the same siloed process in multiple different places all the time. But I will say KYC and, AML compliance are very complicated, and every institution, has things that they need to provide as well. So I think it's creating decentralized credentials and solutions where those credentials are reusable across will help tremendously.
Yeah, and Sergey, any sort of interoperability, bridging type of sort of considerations around some of this as well, if you've got private, public, and permission blockchains all transacting with those same assets?
Yeah, there definitely are. I want to make sure we talk to Dan about all the standard stuff, because I know he's a real standard.
Yeah, I was coming to Dan. Yeah.
You should mention that.
I was going to sweep up everything else.
I just want to answer your past question as well, and interoperability is a part of that. So I think generally, if you don't have interoperability, you don't have access to liquidity, because liquidity is highly fragmented. I think in order for you having access to liquidity to matter, you need to have a lot of high quality assets. So the thing that has really accelerated the industry is that the buy side, BlackRock and a few other buy side asset managers decided to make tokenized funds, right? So in addition to stable coins, the only other category that currently exists on chain in a meaningful way is tokenized funds. And then the third category of collateral management, I absolutely agree, is like a critical third category that could be built off of that tokenized fund trend to a certain degree. So I think you need a high quality buy side issuance of something. You need like something that'll be attracting people to transact. Then you need interoperability, basically because that creates a kind of payments dynamic. And in the case of the Kinexys thing, the thing we did with JPMorgan, that was about connecting two chains, mainly for the purposes of payment against a high quality tokenized asset from Ondo. And then the third thing that you need, to your earlier point, are these standards about how a transaction can happen legally. So in separating the question of regulation, And back to what I mentioned about compliant versus non-compliant capital, the really big unlock for this is the ability to define what a compliant transaction is. And that's the critical thing that I'm hoping that the DTCC can help our industry with, is helping define what a compliant transaction is together with regulators. Because that needs to happen, right? There needs to be a standard for how transactions happen in a legally binding, safe way. And so even if you have interoperability, and even if you have assets that are of high quality, and people want to transact against those assets with a form of payment, if there isn't clarity on how to do that in a legal way, then things fall apart, right?
No.
And so that's, I think what the last really key building block is let's define a transaction in a way where it is legal, that it is compliant. And let's put that on chain or into on-chain systems in a way that is efficient and that can be adopted rapidly. And that's what I think the FMIs like DTCC have a big role to play. And I'm excited to see and hear about.
Yeah, no, similar. And I mean, I look at the technology, it's there. Like, we have the technology to do all of this. So no pressure, Dan, but I'm not going to ask for what you think a timeline is for some of these standards to get deployed, but just from your purview and see, what would you say are sort of the steps to getting towards even just the standard within the US market, but then how does that then expand globally, and who are the key players outside of the US and DTCC that you think need to be involved in that?
Well, I do think one of the fundamental barriers to getting to that state where we're able to operate in a global financial ecosystem efficiently, and I don't think that's far away. I actually think it's much closer than many people realize, and I'm expecting next year to have that be the centerpiece of the tone of this conference is, look, we're finally there. Now, the big problem is fragmentation. And so it's ironic in a world built around decentralization, how territorial everyone is. They've got their favorite layer one, and they figure this layer one is going to dominate all other layer ones out there. Or they've got their favorite financial institution, and this financial institution is better than that financial institution. We're not getting to the desired end state as long as we continue to behave that way. This ultimately is about an ecosystem. So let me just give you some of the problems that we face as an entity. We know that there will be many layer ones. One of the reasons why we know this will be true is you can't scale to every transaction that ever takes place on a single distributed ledger. So there'll be many. What this means is there's some party who's responsible for reconciling total value across chains, or there's some mechanism by which you must actually make those decisions. There's some decision that needs to be made regarding which chains are suitable for $1 trillion worth of assets or $100 trillion worth of assets. That's a governance process. You wouldn't expect that to be a single chain. If it was a single chain, that would be a systemically important chain, and therefore it would be as regulated as major financial institutions are regulated. And I assure you, you would not welcome that task as financial institutions. So we have got to overcome that mindset. Stop elbowing everybody out. One of the exciting things about this room is it takes an enormous set of technology providers, financial institutions, trust agents, in order for us to actually get to the end state. But the centerpiece of that end world is a common understanding of data. Like, truly, what does value mean in the end? Blockchain is really good at measuring transactions, the movement of value of one place to another. But if I've got 100 tokens in my wallet and I want to understand my exposure to interest rate, how are you going to do that? What does that mean? what do those 100 tokens mean in the end? So actually having a data specification that goes along with the tokens when you have 100 in your wallet and you're able to see this particular asset is exposed to political risk in South America. That asset, so the frameworks which allow you to understand the value and the movement of value in the aggregate is a big piece of what we're all working on in order to add that to the overall blockchain world.
Got it. So maybe I'll drop a smoke bomb here and run away. But what I've kind of distilled from this is, Sergey, you're waiting for Dan to put the standards and structure in place for Alex to then adopt, that it feels like in 10 or 15 years, you're just going to disintermediate them out of this space anyway. How do where do those synergies sort of start to diverge a little bit? Not that they're going away in the next 100 years, I think, but
Yeah, so let me explain. There's just like different levels of this problem. There's like a low level, which is where the protocols are. And so in the internet, for example, you have protocols like TCP/IP and HTTPS and SSL and these low level standards, technical standards for how websites and servers connect to each other. That's what Chainlink does. Then there are, in our world, there's like different blockchains. In the internet analogy, that would be different server technologies or database technologies. And then across those database or server technologies, there's standardized formats for transactions, for defining transactions. That's where I feel Dan and DTCC fit in very well, right? So that standardization of how transactions should operate can be built on top of the protocols, right? Because that standardization of how transactions work, how they're defined, how you represent value on a blockchain, can then be updated, can be synchronized using those low-level protocols, right? So you need the low-level protocols, then you need the standardization of how transactions work and what a transaction is and what an asset is and how the asset interoperates with a payment and how does a transaction work in a standardized way. And then JPMorgan is the consumer of both of those things, right? So if you make like a stack, you have low-level things. That's why they're called low-level standards, right? Because they're at the bottom of the stack. Then you have higher-level standards about how transactions properly get formed, how they work, how you define value, how you represent that in various different data structures and schemas, different things. And then you have JPMorgan, who makes money from that, lots of money. And then in addition to JPMorgan, you have other banks, and in addition to the other banks, you have the startups, right? And so I think what we're actually going towards is this internet of contracts that needs a set of standards. You need low-level protocols that interconnect the blockchains, interconnect data systems into the chains and the contracts. You need a level of standards for how transactions work. This is, by the way, things that JPMorgan and other institutions don't want to do. They don't want to do this. And it would actually be hard for them to do it because any standard that one of them comes up with becomes harder for the other institutions to adopt due to various competitive dynamics. That's why historically they haven't made any standards. They usually become members in some consortium and like DTCC or SWIFT, that's the usual model. And then with these standards and these low-level protocols, making it lower cost and simpler to build high-quality financial products, we arrive at the world that Dan described, where the retail investor is able to benefit from higher quality financial products on this internet of contracts. So the thing that actually changes is that the operational cost and complexity of JPMorgan goes down. It goes down to a level where digital banks, startups, Coinbase, whoever can start also doing digital banking things. That competition in the capitalist model creates competition for high quality financial products with low risk and various better features. And the end consumer through the capitalist model benefits. So really everybody wins, in my opinion. And that's kind of the way we're thinking about it. Our goal is not necessarily to define those transactional standards. Our goal is not to provide the financial products. Our goal is to make the low-level standards, the low-level technical protocols, that allow all of this to function down at the lowest level. Like all the way, like we make jokes about us being plumbers and that I'm now a much more well-dressed plumber, basically. That's who I am. I'm just making the pipes. And everyone else is building things on top of those pipes, and then they're gonna be very successful. And then, but the really meaningful thing, the thing that Dan mentioned that I don't think is fully understood, that I think he understands that not everyone does, is that as the cost and complexity of making high quality financial products goes down, you experience a different level of global competition to make better financial products. And JPMorgan is in a very good position to be a winner in that competition. But they, because of all their great work over the last 10 years of blockchain technology, and this is something that their competitors will only realize later, and be in a worse position.
To that end, for the two of you, you mentioned Coinbase. We can rhyme off 10, 15 other digital exchanges, fintechs that are really captured the retail market and seem to now be moving upstream into the at least institutional crypto space. How much of a threat do you think they are to the traditional institutional space and what the JPMorgan type banks are doing today, and where they could potentially lose share of wallet? Obviously, you guys made a conscious decision 10 years ago. We are going to build for this. You guys, with the Securrency acquisition, said we need to be a part of this and a player. What do you think that threat is to just other institutions who are not even fast followers, but the ones that are going to be further behind?
Yeah. I would say from my side, and going off of something you just mentioned, is that innovation is great for everyone because it drives competition to provide better products. And both institutions and consumers benefit from that. And I think it's something that we've seen since the start of time, right? Like whether it be blockchain, whether it be another type of technology, there is always a new innovation that creates competition. And you're always going to have bigger companies and smaller companies. They're going to have different, advantages and disadvantages. Some can move faster, some are slower. But on the large financial side, and if you think about, roles in traditional finance, the balance sheets, the liquidity that they bring into the markets, I don't think it's a one or another. I think together you're creating a better ecosystem of products and possibilities for a wider set of users. So I think it's fantastic that there are different solutions out there and, different types of institutions, whether they be fully crypto native or fully traditional, because everyone is working towards creating the best possible products that benefit the end user.
And I guess, Dan, to that end, then you work with all of the traditional institutions. Where do you see DTCC's role with some of these new entrants into this space that are looking to enable more digital first? Because I know that you guys have done a lot of work on the sandbox side to enable access. So how do you view the adoption or sort of bringing into the fold this more digital first newer entrant?
We see them as new partners, actually. So we're working with a number of those new entrants into this market today. It's actually pretty exciting because they can move at a pace that allows us to push these new ideas much faster in working with those parties. But I would say that there's also an appreciation for the trust models and the existence, the way things are, that they're having to adapt to. Institutions aren't slow and stodgy because they like to be. The trust involved associated with the decisions that are made requires very deliberate thinking. So it's actually a lot of fun to work with new entrants in this regard. You made an earlier point regarding DTCC and its role. Make no mistake about it. We see it all the way up to the leadership level. We will not be here in 50 years, let alone 10 years, if we do not innovate and adapt. Look, blockchain is a technology about consensus. We perform consensus for the U.S. financial markets. That's either an existential threat or a massive opportunity. Well, we've leaned in, starting, and even before the acquisition of Securrency, to the idea that this is a better way to do business. And so we're all in on that concept, and we're excited about not working us versus them, but rather as a community, that these are problems that we all need to solve together. The one aspect of those problems that I find fascinating is the extent to which the old is the new. So the very conditions in the markets that led to the foundation of DTCC 50 years ago was fragmented, whole bunch of transfer agents, and when you wanted to connect to and conduct a trade, any institution that was out there had to talk to 50 different systems and move paper shares here or there. DTCC came together as the mechanism to have that unified, as a DAO, in order to have a unified, standardized mechanism by which electronic transactions took place. Well, in a world where there are many layer ones and many financial institutions, each with their own blockchain solution, there's a need for that unification again. It's actually a revisiting of the old problems. And we're happy to perform that role as a participant, and I think we're actively engaged with technology partners and financial partners on that process of blending the retail and institutional marketplace of the future.
Yeah, no, I really, really appreciate all of those insights. I mean, I couldn't be more excited to be working with all of you guys. Really, from the adoption on the institutional side, which I think we're starting to see the tailwinds really start to accelerate the engagement and hopefully the scaling of the adoption of this. I know we only got a couple minutes left, so maybe just parting thoughts. Would love sort of each of you to, if there was one thing where you could snap your fingers, open your eyes, and it's done to really drive adoption and scaling of this globally, what would you say that is?
All right, I'll go first.
Whoever wants to jump in first.
So I think one of the things that's been missing in the blockchain world is high quality assets on chain, things with an investment thesis. You saw the importance of stable coins on blockchain rails, which provided a unit of account. But if you want real volume and real heavy duty market makers, they have to be able to place their money in things that have an investment thesis, things that produce meaningful yield without necessarily disproportionate risk. That's coming. That's coming very fast, and I think it's going to radically change the kind of value that can be parked on blockchain rails.
Yeah. I think on my side, I have a very long wish list, but I will narrow it down to one. And I think we've all touched on this, and you just mentioned this, Dan, is the speeding up of, getting rid of a lot of fragmentation that's happening. And I think the environment that we're in is very exciting because I think, to everyone's point, we're starting to see progress towards a more open ecosystem and the ability to better connect across. And so I think what that will actually do, it's not really about how that helps us. I mean, it obviously helps everyone here, but it's actually giving investors and clients better access to potential for yield or actually, liquidity that's there and available, and it's not in 3 different places. And now we have to transfer it all back and forth. So for me, if we could speed up kind of getting rid of some of the fragmentation, I think that would help a lot.
Well, I think Sergey is doing that. So.
Yeah, exactly.
Yeah. What are your thoughts, Sergey? I know I got a lot of exposure across the board, so would love.
Yeah, we're definitely solving the interoperability problem across chains in the capital markets at speed now, from the example we showed with JPMorgan and others. So I think that's not what I would say, because I already know that's kind of on a good trajectory. If I could snap my fingers and have one thing happen, it would be the market structure bill in Washington, D.C. being finalized with the language that I want. and that language would unlock the cryptocurrency industry, and it would unlock the regulated, compliant capital markets, on-chain tokenized asset side of the equation, right? So right now, the market structure bill does something for cryptocurrency. In my opinion, it doesn't do enough for highly regulated institutions. So if I could snap my finger, it would solve all the problems on OCC guidance. It would solve all the problems on previous regulatory things. It would direct the regulators between the SEC and the CFTC to make very clear next steps. It would clear separation among those two groups. It would eliminate all ambiguity. And what that would do is it would do 2 things. It would make the U.S. institutions, who are very good at making money, once they're allowed to make money. The thing is, they don't want to make money with this hand and lose money with that hand, right? So it would make the U.S. institutions like you lose money through non-compliance, right? So the best thing for me would be if that could happen in DC, all US institutions go full tilt into blockchain, right? Because they're basically ready, right? Like they're just ready to go, they want to go, and like them going would be very good. And then, because the U.S. is what's known as a super regulator, it's something that ripples out its guidance across the world.
Yep.
That guidance and that model would ripple out across the world. And then you would suddenly have a race. You would have a huge institutional race, like you had with the internet, when the value of internet transactions and having a website was sufficiently large to justify everybody like going crazy about, do you have a website? No? Okay, something wrong with you. Once that happens, that will be like the obvious moment that everyone looks back on, like with the internet. And there was a point at which, if your answer to the question of do you have a website was no, you look like a fool. You look like a foolish person that didn't have their shit together. And that's what everybody in the financial world should be feeling at some point, where they should be coming up to each other and be like, do you have a blockchain? And they should lie. They should be like, yeah, of course, I got a blockchain. Yeah. Sure. I mean, it's go live tomorrow. We'll see. I'll let you know. It's like with email, right? Like, imagine somebody came up to you and said, do you have an email? You don't have an email. You know what email is.
Yeah.
But you better tell this guy, yeah, I got an email. That's where I want to get to. Once you're there, that's it. It's all, we won.
Love it.